Let me ask you something. If you own physical gold or silver right now, when was the last time you actually checked what's happening in the markets? Not the price. I'm talking about what's really happening behind the scenes. Because in the last 72 hours, something shifted. And if you're sitting on bullion without understanding what I'm about to show you, you could be making a critical mistake. Here's what nobody's talking about. The COMEX just reported something that should have every bullion owner paying attention. Commercial short positions dropped by 18,000 contracts in a single week. Now, if you don't follow the futures markets, let me translate what that means. The big banks, the ones who've been betting against gold for years, they're covering their shorts. They're getting out, and they're doing it fast. Why does that matter to you? Because these aren't retail investors. These are the institutions with billion-dollar research departments. They have access to data you and I will never see. And when they start moving in one direction this aggressively, they know something. The question is, do you? Let me take you back to 2008 for a second. September 15th, Lehman Brothers collapses. The financial system is imploding. And you know what happened to gold? It dropped. It actually went down initially. People were panicking, selling everything for cash. Gold fell from $900 to $700 in a matter of weeks. And everyone who didn't understand what was really happening, they sold. They thought gold was done. But here's what the smart money knew. They understood that what looked like weakness was actually the setup for the biggest move in decades. By December 2009, gold was back over $1,200. By 2011, it hit $1,900. The people who sold in that panic, they missed a 170% gain. The people who understood the mechanics, they backed up the truck. I'm bringing this up because we're in a similar moment right now. Not identical, but similar. And if you own bullion, you need to understand what's actually happening, not what it looks like on the surface. So let's talk about what's really going on. The Federal Reserve just did something they haven't done in 4 years. They paused rate hikes. Not cut, paused. And the market's treating this like it's bullish for everything. Stocks rallied, crypto rallied, even gold moved up. But here's what you need to understand. The pause isn't because inflation's under control. It's because something broke. Look at the banking sector. First Republic, gone. Silicon Valley Bank, gone. Signature Bank, gone. Credit Suisse, absorbed by UBS in a weekend deal orchestrated by the Swiss government. These aren't small regional banks having liquidity issues. These are systemic cracks. And every time there's a systemic crack, the Fed has two choices. Let it break or print money to fix it. What do you think they're going to choose? Here's where it gets interesting for bullion owners. The Bank Term Funding Program. You probably didn't hear about this because it wasn't headline news. But the Fed just created a facility that allows banks to borrow against their treasury holdings at par value. Not market value. Par value. You know what that means? It means the Fed is backstopping the entire banking system's bond portfolio. They're essentially printing money without calling it QE. And gold knows, silver knows, the metals are starting to price this in. But most bullion owners, they're still thinking in old paradigms. They're watching the spot price tick up a few dollars and thinking, oh, that's nice. They're not seeing the bigger picture. Let me show you what the bigger picture looks like. China just reported their gold reserves for March. They added 58 tons. That's the 5th consecutive month of purchases. But here's the thing. Nobody believes those numbers. The World Gold Council estimates China's actual purchases are probably 3 to 4 times higher than what they report. Why? Because they're buying through Hong Kong, through London, through private channels that don't show up in official data. And they're not alone. The Central Bank of Poland added 90 tons in the last 6 months. Singapore's been quietly accumulating. Even the Reserve Bank of India, which has historically been cautious about gold, they've added 200 tons since 2022. These are central banks. They're not speculating. They're preparing. For what? That's the question you should be asking. What do they see that we don't? Here's my theory. And I want you to really think about this. The dollar's reserve currency status is under attack, not from one country, from the entire global south. The BRICS nations just announced they're developing a new currency backed by a basket of commodities. Gold is part of that basket. Saudi Arabia is letting their petrodollar agreement with the U.S. expire. They're now accepting yuan for oil. The UAE is settling trade in rupees. France is buying LNG from China in yuan. This isn't conspiracy theory stuff. This is happening right now. And every time a country moves away from dollar settlement, what do they need? They need gold. Because gold is the only asset that every central bank in the world will accept as payment. It's the ultimate settlement mechanism. Now, if you own bullion, you might be thinking, great, this is bullish. My gold's going to go up. And you're probably right. But here's what you need to understand. The move that's coming isn't going to be smooth. It's going to be violent. And if you don't understand the mechanics of how this market works, you could get shaken out right before the biggest move. Let me explain what I mean. The gold market is bifurcated. You have the paper market, which is the futures contracts traded on the COMEX, and you have the physical market, which is actual bars and coins changing hands. These two markets are supposed to track each other, but increasingly, they're diverging. Right now, there are approximately 350 ounces of paper gold for every ounce of physical gold registered for delivery on the COMEX. Think about that. If even 1% of paper gold holders demanded physical delivery, the system would break. There's not enough gold to deliver. And here's where it gets really interesting. The premium for physical gold over spot price has been widening. In Asia, you're seeing premiums of $30 to $50 per ounce over the London fix. In some cases, even higher. That means people are willing to pay significantly more than the official price to get actual metal in their hands. Why? Because they understand something that most Western investors don't. Paper promises aren't the same as physical metal. And when the system gets stressed, paper promises break. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties, and why the structure matters more than most people realize. Worth checking out if that's relevant to your situation. Anyway, back to what's happening in the physical market, because this is where bullion owners need to pay attention. The U.S. Mint just reported sales figures for American Gold Eagles. March sales were up 47% year over year. Silver Eagles, up 63%. These aren't small numbers. This is massive retail demand. But here's what's interesting. Wholesale premiums are actually coming down slightly. You know what that tells me? It tells me the mints are ramping up production to meet demand. They're working overtime. And when you see that pattern historically, it means we're in the early stages of a demand surge, not the late stages. Let me take you back to 2010 for a second. I remember this clearly because I was watching the market every day. Gold was around $1,100, silver was at $17, and the premiums on physical coins were maybe $2 to $3 over spot. Nothing crazy. Then 2011 hit. Gold went to $1,900. Silver hit $49. And you know what happened to premiums? They exploded. American Silver Eagles were trading at $8 to $10 over spot. You couldn't find them. Dealers were sold out for weeks. The people who waited to buy until they saw the price moving, they paid through the nose. The people who accumulated when premiums were low, they got in at reasonable prices. I'm telling you this because we're in that accumulation phase right now. Premiums are elevated compared to 5 years ago, but they're not crazy yet. You can still get metal at reasonable prices, but that window is closing. Now let's talk about what could trigger the next major move. Because if you own bullion, you need to understand the catalysts. There are three main scenarios I'm watching. Scenario 1. The Fed pivots to rate cuts. This is the consensus view. Everyone thinks inflation's coming down, the Fed's going to cut rates, and that's going to be bullish for gold. And they're probably right. But here's what they're missing. The Fed can't cut rates in a vacuum. If they cut rates while inflation's still above 3%, what happens? Inflation accelerates again, and then they're trapped. They either accept higher inflation, which destroys the dollar's purchasing power, or they have to hike again, which breaks something in the financial system. Either way, gold wins. But the path matters, because if we get the inflation acceleration scenario, you're going to see gold move fast. I'm talking 2,500, 2,800, maybe higher in a matter of months. And silver? Silver's going to go parabolic. Because silver has industrial demand on top of monetary demand. And when gold moves, silver moves harder. Scenario 2. Something breaks in the banking system. We already saw cracks in March. But what if it's not over? What if there's another bank that's sitting on massive unrealized losses in their bond portfolio? What if there's a derivatives blow-up? Remember, the derivatives market is over $600 trillion notional value. It only takes one counterparty failure to create a cascade. If that happens, you're going to see a flight to safety like we've never seen before. And I'm not just talking about gold going up. I'm talking about gold becoming unavailable. Because when people panic, they don't want paper promises. They want physical metal, and there's not enough to go around. Scenario 3. Geopolitical escalation. We've got wars in Ukraine and the Middle East. We've got tensions between the U.S. and China over Taiwan. We've got North Korea testing missiles. Any one of these situations could escalate into something bigger. And when geopolitics gets hot, gold is the asset everyone runs to. But here's what most people don't understand. The geopolitical risk isn't just about war. It's about the breakdown of the post-World War II order. The Bretton Woods system, even though it officially ended in 1971, it created a framework where the US dollar was the global reserve currency. That framework is crumbling. And when it fully breaks, we're going to see a repricing of everything. Gold at $2,000? That's pricing in maybe 10% of the risk. If we get a full breakdown of the dollar-based system, gold needs to be at $5,000, $10,000, maybe higher, just to balance the amount of currency in circulation. Now, I know what some of you are thinking. This sounds like doom and gloom. This sounds like fear-mongering. And I get it, but I'm not trying to scare you. I'm trying to show you what the data is saying, because the data doesn't lie. Let me give you some numbers. The M2 money supply in the US increased by 40% from 2020 to 2022. That's $6 trillion of new money created in 2 years. The federal debt is now $34 trillion and growing by $1 trillion every 100 days. The interest on that debt is now over $1 trillion per year. That's more than we spend on defense. How do you think that gets resolved? You think we're going to tax our way out of it? You think we're going to cut spending? Or do you think they're going to inflate it away? If you understand that the only politically viable solution is inflation, then you understand why gold is going higher. Because gold is the anti-inflation asset. It's the asset that maintains purchasing power when currencies lose value. But here's the critical point for bullion owners. It's not enough to just own gold. You need to own the right kind of gold, and you need to own it in the right structure. Let me explain what I mean. If you own gold ETFs, you don't own gold. You own shares in a trust that claims to own gold. Can you take delivery? No. Do you have any control over the gold? No. If there's a systemic crisis, do you think you're going to be able to redeem your shares for physical metal? Probably not. I'm not saying ETFs don't have a place. For trading, for speculation, they're fine. But for wealth preservation, for insurance against systemic risk, you need physical metal that you control. Now, within physical metal, you've got choices. You've got coins, you've got bars, you've got different sizes, and each one has trade-offs. Coins have higher premiums, but they're more liquid. Bars have lower premiums, but they're harder to sell in small quantities. 1-ounce pieces are easy to trade, but if you're buying in size, you're paying a lot in premiums. Kilo bars are more efficient, but not everyone wants to buy a kilo of gold at once. My personal view? If you're just starting out, stick with recognizable coins. American Gold Eagles, Canadian Maple Leafs, Austrian Philharmonics. These are coins that dealers will buy back instantly. You're not going to have any liquidity issues. Yes, you pay a higher premium up front, but that premium is insurance. It's insurance that you can sell quickly if you need to. If you're buying in larger size, then bars make sense. But make sure they're from recognized refiners. PAMP, Valcambi, Perth Mint, Royal Canadian Mint. You want bars that have serial numbers, assay certificates, and are accepted globally. And here's something most people don't think about. Storage. Where are you keeping your bullion? If it's in a safe deposit box at a bank, what happens if the bank closes? What happens if there's a bank holiday? You can't access your metal. If it's at home, what's your security situation? Do you have a good safe? Is it bolted down? Do you have insurance? These are practical questions that matter, because the whole point of owning physical metal is that you control it. But if you can't access it, or if it's not secure, you don't really control it. Now, let's talk about silver for a minute, because if you own bullion, you probably own some silver too. And silver is a completely different animal than gold. Gold is primarily a monetary metal. Yes, it has some industrial uses, but 90% of gold demand is investment and jewelry. Silver is different. About 50% of silver demand is industrial. It goes into solar panels, electronics, medical devices, batteries, and that industrial demand is growing. Here's why that matters. If we go into a recession, industrial demand for silver drops, and silver can get hit hard. We saw this in 2008. Silver dropped from $20 to $9. It got crushed. But then, when the economy recovered and the Fed started printing money, silver went from $9 to $49 in less than 3 years. It outperformed gold by a massive margin. So if you own silver, you need to understand that it's more volatile than gold. It's going to have bigger swings. But if you can handle the volatility, the upside potential is much larger. Right now, the gold to silver ratio is around 85. That means it takes 85 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 60. And in bull markets, it can go down to 30 or 40. If we see that happen again, silver is going to massively outperform gold. But here's the thing. You can't just own silver and hope. You need to have a plan. You need to know at what price you're going to take profits. You need to know how much volatility you can handle, because silver will test you. It will drop 20% in a month and make you think you made a mistake. And then it will rip 50% higher in 6 weeks and make you wish you bought more. That's the nature of silver. And if you can't handle that, stick with gold. Gold is the steady, reliable asset. Silver is the high beta play. Now, let me address something that I know is on a lot of bullion owners' minds. Confiscation risk. People worry that the government is going to confiscate gold like they did in 1933, and I understand the concern. But let me give you some context. In 1933, the U.S. was on a gold standard. The dollar was backed by gold. So when FDR confiscated gold, it was because they needed the gold to back the currency. Today, we're not on a gold standard. The dollar is a fiat currency. It's not backed by anything. So the government doesn't need your gold. Could they still confiscate it? Technically, yes. The government can do whatever it wants. But practically, it doesn't make sense. There's no economic reason to confiscate gold today. And politically, it would be a disaster. Can you imagine the backlash? My view is that confiscation risk is overblown. But if you're really worried about it, there are ways to mitigate it. You can own gold in different jurisdictions. You can own gold through structures that provide legal protection. You can own numismatic coins, which were exempt from confiscation in 1933. But honestly, I think the bigger risk isn't confiscation. It's taxation. Because governments are broke. They need revenue. And they're going to look for ways to tax wealth. Capital gains taxes could go up. They could implement wealth taxes. They could change the rules on how precious metals are taxed. That's why structure matters. And that's why, if you have significant wealth in retirement accounts, you need to think about how to protect it. Because the tax code is going to change, and you want to be positioned in a way that minimizes your exposure. Let me bring this back to where we started. If you own bullion, you need to understand what's happening in the markets right now. You need to understand that we're in a transition period. The old system is breaking down. A new system is being built, and gold is going to play a central role in that new system. But the transition isn't going to be smooth. There are going to be moments of panic. There are going to be moments where gold drops and everyone thinks it's over. And those are the moments where weak hands sell and strong hands buy. The question is, which one are you going to be? Are you going to be the person who panics when gold drops $100 and sells at the bottom? Or are you going to be the person who understands the bigger picture and uses those drops as buying opportunities? Because here's what I know. The fundamentals for gold have never been stronger. Central banks are buying. Governments are printing money. The dollar's losing its reserve status. Geopolitical risks are escalating, and the amount of physical gold available is limited. All of those factors point in one direction. Higher prices, much higher prices. But the path to those higher prices is going to be volatile. And if you don't have conviction in why you own gold, you're going to get shaken out. So let me ask you this. Why do you own bullion? Is it because you think the price is going up and you want to make money? Or is it because you understand that gold is insurance against systemic risk? Because if it's the former, you're going to have a hard time holding through the volatility. But if it's the latter, if you truly understand that gold is wealth preservation, then the volatility doesn't matter. Because you're not trying to trade it. You're holding it as insurance. And insurance doesn't expire. Insurance doesn't lose value just because the price fluctuates. Insurance is there for when you need it. And I'm telling you, we're moving into a period where you're going to need it. The signs are everywhere. The banking system is fragile. The currency system is breaking down. Governments are desperate. And the people who understand what's coming, they're preparing. They're buying gold. They're buying silver. They're getting their wealth out of the system and into assets they control. If you own bullion, you're already ahead of 99% of people. You've already made the decision to protect yourself. But now you need to make sure you're doing it right. You need to make sure you own the right metals, in the right structure, stored in the right way, because the details matter. And when the crisis hits, it's going to be too late to fix mistakes. So here's what I want you to do. Take a look at your bullion holdings. Ask yourself these questions. Do I own physical metal or paper promises? Is my metal stored securely? Can I access it if I need to? Do I have a plan for what I'm going to do if prices spike? Do I have a plan for what I'm going to do if prices drop? If you can't answer those questions confidently, you've got work to do. Because owning bullion isn't a passive investment. It requires thought. It requires planning. And it requires conviction. But if you do it right, if you understand what you own and why you own it, then you're going to be positioned for what's coming. And what's coming is going to be historic. We're going to see a repricing of monetary metals that people will talk about for decades. And the people who position themselves correctly, they're going to preserve and grow their wealth in ways that most people can't even imagine. That's the opportunity. That's what's at stake. And if you own bullion, you're already in the game. Now you just need to make sure you're playing it right.